everyone, welcome to my channel. I'm Lavanya. In the previous video lecture, we had discussed about the meaning and types of internal reconstruction. Let's start the session with accounting treatment of internal reconstruction. When face value of the share is reduced. First of all, what is face value? Face value is a financial term used to describe the nominal value of the share. Reduction of share can be made only on paid up value or both on paid up as well as face value of shares. Now what is paid up value? Paid up capital is an amount of money a company has received from shareholders in exchange for shares. In simple, paid up value means how much value is paid against the share. Before we get into journal entries, we have one more important term here, capital reduction. Now the capital reduction account is a temporary account opened in order to carry out the internal reconstruction. The capital reduction account represents the sacrifice made by shareholders, debenture holders and creditors, etc. Before we get into the journal entries, let us first check the simple and easy rule that helps us to easily pass the journal entries. When liability increases, you will credit the value, and when liability decreases, you will debit the value. I repeat, when liability increases, you will credit the value. When liability decreases, you will debit the value. Whereas, when asset increases or appreciates, you will debit the value. When asset depreciates, you will credit the value. I repeat, when asset appreciates, you will debit the value. When asset depreciates, you will credit the value. This simple rule will help us to pass the journal entry. Let's look into the first entry. When the face value of share is reduced, whether it is equity share or preference share, whenever face value is reduced, you have to scrap off the old share. Now let's see how to do it. Shares are the liability. So to remove the liability or to decrease the liability, we will debit the value. So the entry is old equity share capital account debit to new equity share capital to capital reduction account. Now why we have credited new equity share capital? Because new capital or liability is created. Now the shareholders lost the amount, but the company gained it. So now the value which the company gained will be credited to capital reduction account. So the entry will be equity share capital account debit to equity share capital, that is new equity, to capital reduction account. The difference between the old share value and the new share value will be transferred to capital reduction account. Now the same thing holds good for preference shares as well. Now old preference share capital account debit to new preference share capital to capital reduction account. So the difference between old and new share will be transferred to capital reduction account. The same entry will be passed for debenture as well. When the debenture holders agree to accept new debentures for lowest amount, then old debenture account debit to new debenture account and the remaining amount will be transferred to capital reduction account. Whenever there is decrease in the face value, then you need to scrap off the old share. But whenever there is decrease in paid up value, I repeat, whenever there is decrease in paid up value, then there is no need to scrap off the shares. So the entry will be simple. Repeat, share capital account debit to capital reduction account. Since liability is getting decreased, we have debited share capital, and the amount, the gain which the company gets will be transferred to capital reduction account. Now the next entry is sacrifice by debenture holders and creditors. When the debenture holders and creditors have sacrificed their amount, then the liability of the company decreases. So whenever there is decrease in the liability, we will debit the value. So the entry will be debentures account debit, creditors account debit to capital reduction account. Next entry is when there is decrease in the value of liability. When the value of liability decreases, then we will debit the value. When the value of liability decreases, we will debit the value. So the entry here is liability account debit to capital reduction account. Next entry is when there is increase in the value of liability. So when the value of liability increases, we will credit. So the entry is capital reduction account debit to liability account. Now exactly opposite to the liability entries here, when there is an appreciation in the value of an asset, when asset appreciates, we will debit the value, and when asset depreciates, we will credit the value. I repeat, when assets appreciates or increases, we will debit the value, and when asset decreases or depreciate, we will credit the value. So the entry will be asset account debit to capital reduction account. Now let us see when the asset depreciates in the value of an asset, then the entry will be capital reduction account debit to asset account. Next entry is when the utilization of capital reduction account balance in writing off the accumulated losses and various fictitious assets. The capital reduction amount is utilized to write off all the fictitious losses or overvalued assets and accumulated losses. So the entry is capital reduction account debit to P&L account, preliminary expenses, discount on issue, underwriting, advertisement, suspense account, reconstruction expenses if any, goodwill, patent, trademarks, fixed assets if it is overvalued, other assets if there is any, and the remaining balance will be transferred to capital reserve account. If there is any balance left, then we will transfer the balance to capital reserve account, that is capital reduction account minus all these values will be transferred to capital reserve account as balancing figure. Now P&L account debit balance, trademarks, copyrights, goodwill, reserves have to be written off if they mention in the question, if they state in the question or not, we have to write off all these values. I repeat, whether they mention in the question or not, you have to write off P&L account, debit balance, trademarks, copyrights, goodwill if there is any, reserve have to be written off completely. Now let us look into the question to understand the concept better. A public limited company passed the necessary resolution and received the sanction of the court for reduction of capital by rupees 5 lakh. They decided to write off 2,10,000 losses, plant and machinery of rupees 90,000, goodwill of rupees 40,000 and investment of rupees 8,000. Now the reduction was made by converting 50,000 preference shares of rupees 20 each fully paid to the same number of shares of rupees 15 each fully paid. Let me repeat the point. There is a reduction where by converting 50,000 preference shares of rupees 20 each fully paid to the same number of shares of rupees 15 each fully paid. So they are converting the face value of shares from 20 to 15. Now let us pass the entry. Preference share capital account debit. That means 50,000 into 20. The old value of the share is 20 rupees. So 50,000 into 20 comes to 10 lakh rupees. Now the new value is 15 rupees. So this is 50,000 into 15. So to preference share capital account, 50,000 into 15 comes to 7,50,000. To capital reduction account, that is the difference between the old share and the new value of the share. So 10 lakh minus 7,50,000 will be 2,50,000, that will be transferred to capital reduction account. I repeat the entry. Old preference share capital account debit, that is 50,000 into 20, to new preference share capital, that is 50,000 into 15, to capital reduction account, that is balance value between the difference value between 10 lakh and 7,50,000 will be 2,50,000. So the narration will be being preference share of rupees 20 each will be reduced to rupees 15. So let's continue the statement further. 50,000 ordinary shares of rupees 10 each fully paid to 5 each fully paid. So again the face value of the share is getting reduced from 10 to rupees 5. So the entry will be ordinary share capital account debit, that is 50,000 into 10, 5 lakh, to ordinary share capital account, that is 50,000 into 5, 2,50,000, and the remaining balance, the difference between these two values, will be transferred to capital reduction account, that is 5 lakh minus 2,50,000 will be transferred to capital reduction account. So the narration will be being equity share of rupees 10 each reduced to rupees 5 each. So let's look into the next entry. Now they have asked us to write off the losses and plant and machinery to the extent of 90,000, goodwill 40,000 and investment 8,000. Now these values can be written off with the help of capital reduction account. So let's pass the entry. Capital reduction account debit. Now we have credited the value of rupees 2,50,000 in the first entry, and we have also credited 2,50,000 in the second entry. So the total value that we have in the capital reduction account is 5 lakh rupees. Now let us try to write it off, the values which we have here. First of all, we have losses of rupees 2,10,000. Let's credit it to profit and loss account, 2,10,000. We have plant and machinery to the extent of 90,000. So to plant and machinery account 90,000. We have goodwill of 40,000. So to goodwill account 40,000 and investment of rupees 8,000. So investment, that is to investment 8,000. I repeat, capital reduction account rupees 5 lakh, which is debited to plant and profit and loss account 2,10,000, plant and machinery account 90,000, goodwill 40,000 and investment 8,000. Now the remaining balance between these two will be transferred to capital reserve account, that is 5 lakh minus 2,10,000 minus 90,000 minus 40 and minus 8,000. The remaining 1,52,000 will be transferred to capital reserve account. So the narration will be being capital reduction is used to write off accumulated loss, depreciation on assets, and the balance value will be transferred to capital reserve account. So that's it for this lecture. Please comment below if you have any questions. We'll meet very soon in the next video lecture. Till then, happy learning. Stay tuned.